Welcome to the InterMarket Analysis Update. This is a video that I do once a week where I look not only at other areas within the stock market, I also look outside of the stock market because sometimes we can get some clues as to what's happening. The first thing that we look at is a thing called S&P 500 valuation. Are we overvalued, just about fairly valued, or undervalued right now? This chart looks at the trailing 12 months over a period of time to try to gauge on a historical basis, are we expensive, just about right, or undervalued? We have a PE ratio of 20. 20 and above means that we're overvalued. When we're in between 11 and 19, that means that we're fairly valued, and 10 and below means that we're undervalued. The black line on this chart is the S&P 500. The next line down is the PE ratio of 20, and we're well above that. So that's suggesting on a historical basis that we are overvalued. We also can look at this over a period of time, going back to 1980 and different events that have happened and what the historical PE ratios were during that time. Another thing that we look at is the Shiller PE ratio. This takes more of an average over a longer period of time to get an idea of where are we at as far as valuation. Right now, we have a 30.78 reading for this ratio. Well, what does that mean? We look at this box in the middle and we have the median and the mean between 16 and 17, where we're over 30 right now. So on a historical basis, this also suggests that we are overvalued. But the stock market doesn't do that. They look forward. We use that same scale of 10, 15, and 20 to look forward based on earnings projections and forecasts. And as of Friday's session, looking forward, the S&P 500 has a PE ratio of 19. We're under that 20 level, but above 15. We also look at the mid caps, where right now we have a PE ratio looking forward of 13.7. And then with the small caps, it's at 13.5. So looking forward, we are still justifying this idea that prices could go higher, but on a historical basis, we are very overvalued. Then we look at growth versus value. This first index is just a growth index showing that we're in an overall downtrend. We also look at a value index. Then we do some ratios between the two. We look at an ETF that shows that growth has been underperforming value, but we're just seeing a golden cross with this ratio, suggesting that even though they're both down, growth is performing better than value. Here's an inverse of that same chart showing now that value is underperforming growth. Then we look at indexes showing that growth is starting to outperform value, and here where value is underperforming growth. Then another index that we look at also shows that growth is outperforming value, or taken another way, value is underperforming growth. Then we look at the small caps and we look at growth and value within the small caps. They are still in an overall uptrend, even though the index has been going down, but we've been chopping sideways more or less recently. We look at the mid caps in an overall uptrend, even though the index itself has been going down, and this is holding up a little bit better than the small caps. Then we look at S&P growth to value, where we've been chopping sideways even though we're in an overall uptrend, seeing some recent weakness here. We want to see growth really outperform value. That's when we see the market really have some strength to go higher. We also look at growth versus value this way, showing that growth is really improving compared to value, and inverse of that is how value is underperforming growth. Look at some inflation gauges. This is a monthly chart of the CRB index on top, where we're turning back up, but we're still in an overall downtrend. We take a ratio between inflationary areas and deflationary areas, showing that we're below this moving average, and the moving average itself is going down, suggesting that inflation is not really a problem right now. We look at the CRB index, which continues to be in an overall downtrend. Then we look at the Baltic Dry Index. How much does it cost to ship products from one place to another? This is also in an overall downtrend. Then some other markets. Aluminum is in a downtrend. Corn going down. Wheat down. Fertilizers going down. Lumber is in a downtrend. Gas pretty much in a downtrend. Oil in a downtrend. Heating oil downtrend. Natural gas downtrend. Diesel prices also heading lower. Copper, which is still in an overall uptrend, but it's seeing some weakness and it's bouncing all around. We look at this as a barometer looking forward. That means that they're projecting better economic times in the future. When it's going down, that means we might have economic difficulties. And even though we're chopping all over the place, we're still in an overall uptrend, but we're getting ready to see a death cross here. We compare copper to gold. When the economy is looking better, copper tends to outperform gold. When the economy is not looking as good, gold outperforms copper. The copper to gold ratio is heading down overall, even though copper has been bouncing back as of late compared to gold. Then we look at this on a longer term basis. That's the black line. And then we compare this with the 2-year yield and the 10-year yield. We are pretty far apart from those yields right now as this ratio has been going down over a period of time. They tend to go in the same general direction, and they tend not to get too far apart from each other, even though they're on different scales. We're seeing a really wide spread between all three right now. Then we look at gold on the top and how it's been doing just with a price chart, and silver on the top, and then noticing that there's a very high correlation between the two. We also look at the gold to silver ratio that we just saw, and then we compare it with the dollar index. As a general rule, when the dollar index is going up, gold outperforms silver. When the dollar index is going down, which is what it's been doing lately, silver outperforms gold. And that's what is happening right now, and the correlation between the two is still fairly strong. Gold has been in an overall uptrend, even though it's chopping sideways. Silver is also in an uptrend, even though it's underneath its 50-period moving average. The dollar index had been trying to bounce back up, but now we're seeing some more weakness, and this has been giving some support to stocks. The euro is going up when compared to the dollar. And then we have the Japanese yen, which is under a little bit of pressure right now, but still in an overall uptrend. Here's the euro, and then the dollar index is on the bottom. The Japanese yen has been underperforming. Even though it's in an uptrend, we could be getting ready to see a death cross with this ratio. The British pound has been really outperforming the US dollar. Some different indexes. The equal weight index, even though it's been showing some improvement, continues to underperform the S&P 500. This just means, like what we've been hearing, is that it's a small group of stocks that are really leading the markets higher. If you were to take those stocks out of the indexes, we would pretty much be flat. The NASDAQ 100 is really outperforming the S&P 500. And the S&P 500 is outperforming the CRB index, where the CRB index continues to underperform the S&P 500. The S&P 100, the 100 biggest stocks in the S&P 500, are really outperforming the rest of the S&P 500. Small caps are really struggling when compared to the S&P 500. The NASDAQ is outperforming the S&P 500, and the NASDAQ 100 is outperforming the rest of the NASDAQ. Looking at the S&P 500 and comparing it to other stocks, I look at this every day in the daily updates. This is the NYSE advanced decline line, where it's above its moving average. Then we have the S&P, the mid caps, and the small caps. We keep an eye on the 30 biggest software companies, which continue to be in an uptrend. The mega cap, this is where the real strong growth has been coming from, and they're in a solid uptrend. We compare mega cap growth with the equal weight index, showing how the big boys are really outperforming the rest of the market. We keep an eye on the robotics and AI ETF, which has been performing quite well, but when you compare it to the tech sector, it's not really outperforming that much. This is the Dow Jones Composite Average, where we take the Dow, the transports, and the utilities and put it together as one composite. We're still in an overall uptrend, showing some strength overall, but we've been pretty much chopping sideways. Low volatility stocks, which held up quite well in 2022, they're bouncing pretty much sideways still in 2023, even though they're still in an overall uptrend. But when we compare it to the S&P 500, they are really underperforming. FANG stocks, which is another area that's seen a lot of strength. Also have a newer chart here that I've been following on the daily video. We're coming back up to the all-time high in the FANG index at about 8,000. Will that offer overhead resistance, or will we be able to break through that? ARK, also looking a little bit better. We've seen a golden cross on the daily chart, and we're also close to seeing a golden cross on the weekly chart. Looking at traditional Dow theory, where we had been seeing more of a negative divergence with the transports, but lately the transports have been coming back. We were seeing a short-term negative divergence with the utilities, but they are showing some improvement. Then a new take on Dow theory looks at the S&P 500 on top, where it's been doing really well, and then the NASDAQ, which is a broader range based more on tech, that has been really breaking out, so we're seeing a positive divergence between these two indexes. Then we look at U.S. stocks based on the S&P 500, and then we look at stocks in Europe, Asia, Australia, and the Far East. We're still above this red moving average on this monthly chart, and we're also seeing the PPO turning up longer term, so that is positive. suggesting that U.S. stocks are outperforming other world stocks. Looking at bonds, the ETF for the bond is still in an overall uptrend. The Pring World Bond Index is still looking okay, but it's been very choppy. High yield, which means junk bonds, continue to be in an uptrend, and investment grade bonds are chopping sideways but are still in an uptrend. Bonds, though, still continue to underperform stocks. Then we look at the stock-to-bond correlation. They're fairly neutral right now, having a slight tendency to go in the same direction. On a monthly chart, it shows that stocks continue to outperform bonds. And the corporate bonds are pretty much chopping sideways, but are in an uptrend. Then we look at the 5-year yield. It's coming back up above this moving average. When we look at the special K, it's in a downtrend, but when we look at the KST, it's rolling over a bit, but still in a faint uptrend. Also looking at the 5-year yield with the different studies for the KST, short term we're positive, we're turning back up slightly in the intermediate term, but longer term we continue to be in a downtrend. Then long-term bond ETF, which has been underperforming overall. With a short-term look with the KST, it's in a downtrend. We're rolling over negative in the intermediate term. We're still hanging on to a long-term uptrend. And the MOVE Index, which measures volatility of bonds, it's been dropping as bonds have been going up. The VIX has also been dropping as stocks have been going up, and the correlation is still pretty strong between the two. Here's just a look at the 10-year yield. Another look at the 10-year yield where it broke out back in 2022. And then we're also comparing the 10-year yield with the S&P 500, and the S&P is outperforming the rise in interest rates. Here's a look at the 30-year yield and different Fibonacci retracement levels. Junk bonds continue to be in an overall uptrend, and junk bonds are outperforming government bonds, which is probably how it should be. Looking at a daily chart of the different yields where we have been going up, chopping down a little bit, and then saw a rise in Friday's session. A weekly chart looking internationally showing the US, the UK, and German rates are going back up. Japan is its own little story, and we're keeping an eye on that. We also look at some other charts comparing riskier bonds with more conservative bonds, and folks are tending to prefer the riskier bonds because they give a better return. Then we look at a broad range of different indexes and compare them to bonds. First, the S&P is really outperforming shorter-term bonds. A broad market ETF that we look at is outperforming a little longer out bonds. And the tech sector is really outperforming longer term bonds. And then we look at different sectors. Here's the materials sector, which continues to be in a downtrend when compared to the S&P. Communication is still in an uptrend compared to the S&P. The energy sector is in a downtrend, where the financials are also in a downtrend. But we're keeping an eye on this. This could be positive. We're going back to a high set back in 2007. We came up to that level before and then came back down. Well, back in 2020, we broke through that level with the financial sector. What once had been resistance is now support. And when we started getting all that negative banking information coming out, it came down to this level. And as of right now, this support level is holding. Can we see a real bounce up off of that and see some recovery in the financial sector? That would help the overall market. Then we look at industrials, which are starting to underperform the S&P, and the tech sector, which is outperforming the S&P, staples, which are underperforming, and real estate, which is also underperforming, utilities, which are underperforming, healthcare, which is underperforming. And here's another look at healthcare showing the ratio in a decline. That's more of a defensive posture. And the S&P is outperforming utilities, which could give some good support to stocks. And I cover this each day in the daily videos. The staples sector is still in an overall uptrend. It had seen some weakness, but now it's been bouncing back. We look at discretionary to the S&P, which is showing a lot of improvement. This is where your growth really comes from. And the tech sector is in an overall uptrend. Semiconductors also really doing well. The tech sector to the S&P shows tech is outperforming, where energy now is underperforming technology, and growth stocks are outperforming bonds, and the tech sector is now finally outperforming the rise in interest rates. Here's an inverse showing how the 10-year yield has been going down compared to the rise in the tech sector. Discretionary is now starting to outperform the staples, where staples are now underperforming discretionary. Gold is still hanging in there with an uptrend, but we're seeing some recent weakness when compared to the S&P. Gold is also holding up fairly well when compared to the dollar. We came right up to this resistance level, came back down, Now we're seeing if gold can stage a bit of a comeback. High leverage loans continue to hold up well, suggesting that the economy is still strong. The Wilshire is also hanging in there fairly well. The NYSE composite still in an overall uptrend. The small caps, though, are underperforming the S&P 500. All stocks are in an overall uptrend. Emerging markets chopping sideways, but seeing some positive action lately. And here's going back to the beginning of 2023, where stocks are doing the best, followed by gold. Then we have bonds, and then we have the dollar, where energy, which had been such a stellar performer in 2022, it's down on the year looking at 2023. Then Bitcoin, which had a recent golden cross, tried to get up to this 30,000 area, has been dropping back down, but is still in an overall uptrend. Then internationally, China's starting to turn back up, emerging markets, Europe, Japan, and the US. So looking on a global basis, stocks are trying to recover. Looking at some correlations, we compared the S&P to oil, where they're having a slight tendency to go in opposite directions. The S&P to the dollar, they're really going in opposite directions. And then the tech sector, the 10-year yield, almost neutral, but having a slight tendency to go in the same direction. The S&P to the 10-year yield, also slight tendency to go in the same direction. Then we compare the S&P to the 2-year yield. They're having a tendency to go in the same direction. Then we keep an eye on the home builders ETF. On top is the S&P. Then we have the home builders ETF. We have the ratio down here, and then we keep an eye on the relationship overall. We're not really seeing anything that strange right now. Looking at some long-term trends, this is a monthly chart of the NYSE composite, and the Copic curve is also showing that we're showing some improvement with a positive trend. Then we look at the NYSE composite, also going up in an overall uptrend. Then we look at the S&P with a longer range PPO, and that's also in an uptrend. The KST, though, is still looking negative. And when we compare the S&P to the CRB index, the S&P is outperforming. So let's make our list and see what is positive. Now, positive to me is when the 50-period simple moving average is above the 200-day simple moving average. I know there's other ways you can do this, but I just wanted to keep this simple. The big software companies are positive. The euro, the Japanese yen, and the British pound are still positive against the dollar. Copper, gold, and silver, and the mega caps are in uptrends. The low volatility ETF, even though it's showing some weakness on a relative basis, is still in an uptrend. The Dow Jones Composite Average, FANG, and then we've added ARK to that list. All the different bonds that we look at continue to be in overall uptrends. Staples, tech sector, and semis, high leverage loans, the Dow, the NASDAQ and NASDAQ 100, the NYSE composite, as well as the Wilshire, all stocks, emerging markets, and Bitcoin. Even though it's seen some weakness, it's still in an uptrend. So what is negative? This is when the 50-period moving average is below the 200-period moving average. The growth indexes that we look at, they're still in a downtrend, as are the value indexes. The CRB index, we still have the dollar index, which is in an overall downtrend. And the mid-caps are starting to look much more positive and have shown us a recent golden cross, so that should be removed from this list. Thank you. I hope you found this helpful. Please feel free to check out the daily and weekly video that I post. After this, I do my last video of the week, where I do a deep dive video where I go through a lot of the charts that I didn't cover this week in any of the daily videos. Have a really nice weekend, and I will talk to you in the next video.